Capital has only two real weapons: patience and pressure. One waits for decades while the other burns billions in months. One compounds quietly while the other rewires entire industries at a loss. Both dominate markets. Both bend reality around themselves. And both prove something uncomfortable for modern investors. Capital doesn't need to be right. It needs to decide how it wants to win. Warren Buffett and Elon Musk are not opposites by personality. They are opposites by time preference. And this is Dark Alpha, where value meets velocity. This topic matters now because capital is confused. For the last decade, markets were trained to believe that speed equals intelligence, that disruption equals superiority, that whoever moves fastest deserves to win. Then inflation returned, rates rose, liquidity thinned. Suddenly, patience looked intelligent again. At the same time, technology accelerated beyond traditional valuation logic. AI, space, energy, autonomy, these are not quarterly stories. They are generational capital commitments. And investors are caught between two instincts. Do you wait for certainty, or do you burn capital to create inevitability? Buffett and Musk embody this fork in the road. Buffett shows what happens when capital refuses to chase narratives, refuses to rush, and instead exploits time itself as a weapon. Musk shows what happens when capital is used aggressively, not to price risk accurately, but to force outcomes before competitors can react. If you misunderstand this divide, you misunderstand modern capitalism. You misread why some companies survive decades without innovation headlines, while others lose money for years and still dominate their industries. You misjudge whether today's losses are weakness or simply prepaid control. For investors, founders, and decision-makers, this isn't a personality debate. It's a capital allocation question with irreversible consequences. Choose wrong, and you don't just lose returns, you lose relevance. Capital is often described as rational. That's a comforting myth. Capital is not rational. Capital is conditional. It responds to incentives, constraints, and time horizons. The mistake most people make is assuming capital always wants the same thing: profit, efficiency, optimization. In reality, capital wants control over outcomes. Sometimes that control is achieved by waiting, letting weaker players exhaust themselves. Sometimes it's achieved by spending, overwhelming the system until alternatives collapse. Buffett and Musk didn't invent these approaches. They refined them to extremes. Buffett operates inside mature systems: insurance, consumer goods, banking, energy. Systems where the rules are stable, demand is predictable, and time rewards discipline. In those systems, speed is dangerous, leverage is lethal, and impatience is punished. Musk operates in unstable systems: space launch, electric vehicles, autonomy, energy grids. Systems where the rules are still being written and early dominance shapes the future structure. In those environments, waiting is fatal. Underinvesting means irrelevance, and profit too early can signal weakness. This isn't old versus new. It's not value versus growth. It's about whether time works for you or against you. Buffett assumes time is his ally. Musk assumes time is his enemy. One collects optionality, the other destroys it, on purpose. Most investors fail because they mix these logics. They apply Buffett patience to Musk-style markets, or Musk aggression to Buffett-style businesses, and both approaches fail outside their natural habitat. Understanding this difference is no longer optional, because capital markets are fragmenting. Some sectors are aging gracefully, others are accelerating violently. The question isn't which man is smarter. The question is, which model does this environment reward? Let's start with Buffett. Not the personality, the mechanism. Buffett's core advantage is not stock picking, it's capital permanence. Berkshire Hathaway is structured so capital almost never leaves. Insurance float, deferred taxes, permanent equity. This gives Buffett something most investors never have: time without pressure. When capital doesn't fear redemption, it behaves differently. It doesn't chase momentum. It doesn't respond emotionally. It doesn't optimize for headlines. It waits. Waiting is not passive. Waiting is predatory. Buffett waits for pricing errors created by urgency elsewhere. When others must sell, he buys. When others chase yield, he demands margin of safety. When others optimize for quarterly optics, he optimizes for decades. This works because Buffett plays in environments where demand doesn't vanish. Brands decay slowly. Regulation protects incumbents. Scale compounds quietly. Coca-Cola doesn't need reinvention every year. Insurance doesn't disappear because of a new app. Railroads don't get disrupted by enthusiasm. In these systems, capital that waits eventually inherits the field. But here's the subtlety most people miss. Buffett is not slow. He is selective about where speed matters. When opportunities appear that fit his time advantage, he moves decisively. Massive checks, simple structures, no negotiation theater. The patience is upstream. The execution is immediate. This is the first reframing moment. Buffett is not anti-risk. He is anti-unpriced risk. He doesn't avoid uncertainty. He avoids situations where time doesn't compensate him for it. And this only works because Berkshire can survive indefinitely without growth. That's the real moat. Now contrast this with how capital behaves when time is not your friend. Which brings us to Musk. Elon Musk does not wait. Not because he's impatient, but because delay increases risk. In Musk's worlds, the first viable scale player defines the cost curve, the supply chain, and the regulatory narrative. If you hesitate, someone else sets the rules. So Musk burns capital early, aggressively, to compress timelines. Tesla didn't optimize for margins first. It optimized for production learning curves. SpaceX didn't optimize for profitability. It optimized for launch cadence and vertical integration. Losses weren't failures. They were tuition. This is capital as pressure, not patience. Instead of waiting for mispricing, Musk creates it. He forces competitors into capital structures they can't sustain. Legacy automakers couldn't lose money long enough. Aerospace incumbents couldn't iterate fast enough. Musk weaponized burn. But here's the trade-off. This model only works if capital markets remain open. Narrative credibility is maintained. Technological advantage compounds faster than losses. The moment any of these break, the system becomes fragile. Buffett's model is anti-fragile to time. Musk's model is anti-fragile to speed, but fragile to capital constraints. And this is where most observers get it wrong. They ask, who's winning? That's the wrong question. The real question is, which environment survives stress? High rates punish burn, low rates reward it. Stable demand rewards patience. Unstable markets reward aggression. Buffett and Musk are not competitors. They are stress tests for capitalism under different conditions. If the Buffett model dominates, capital concentrates quietly. Returns look boring. Volatility decreases. Innovation slows, but systems stabilize. This favors institutions, pensions, insurance, long-duration capital. It punishes speculative ambition. If the Musk model dominates, capital becomes kinetic. Losses are tolerated. Monopolies emerge faster. Whole industries reconfigure. This rewards founders, early investors, narrative builders. It punishes late entrants and conservative allocators. The danger is not choosing one model. The danger is misapplying them. Burning capital in slow industries destroys value. Waiting in fast-moving markets guarantees irrelevance. Capital doesn't fail because it's wrong. It fails because it chooses the wrong tempo. The future of capitalism will likely fragment. Some capital will slow down, harvesting stability. Some will accelerate, forcing new structures into existence. The skill won't be intelligence. It will be timing preference. Here's the unresolved tension. Both Buffett and Musk are right, and both models break under the wrong conditions. The next decade will not reward ideology. It will punish rigidity. Investors will need to ask a harder question than, is this cheap? Or, Is this disruptive? They'll need to ask, does time work for this capital? Or against it? Because the most dangerous mistake is not losing money. It's committing capital to a strategy whose clock is ticking in the opposite direction. Patience and pressure are not virtues. They are tools, and tools only matter if you know when to use them. The market won't tell you. Narratives won't warn you. Time will, quietly, relentlessly. And by the time the answer is obvious, capital will already have chosen sides.